Hello guys, Marco Schwartz here, and in this video you will learn about the 3 mistakes you need to avoid when investing in dividend growth stocks. So I made a lot of mistakes when I first started investing in those stocks that are paying a dividend. So these stocks are now the main part of my portfolio. They are paying me dividends every month, so every month there is passive income coming into my accounts from those dividend paid stocks. However, when I first started, there was a lot of mistakes that I made, and I want you to avoid those mistakes by following what I will tell you in this video. And mistake number 1 was really to focus on the returns from the stocks, okay? So there is something for all the stocks called the yield, and that's basically the amount of money that it will give you every year compared to the price of the stock, okay? So for example, if your dividend stock has a yield of 5%, it means that if you invest $1,000 in this stock, it will give you $50 back per year, okay? Very simple. However, I just said 5%, but there are some stocks that have yields of 8, 10, 15%, even more. And when I started, I actually thought that it was just about this, it was just about the dividend yield. And I just invested in those stocks that have very high yield, and well, it didn't turn out too well for some of them. So there are many reasons about why those yields are so important. And the first one, which is like the bad reason, is like those stocks can be exceptionally low, right? So they can have some problems actually, and investors are just selling and selling them. And therefore, what you see as a new investor is a very high yield, so a very high return. But actually, it's not because the company is doing great. It's because it's actually doing very bad and the price of the stock is going down. And therefore, probably in the near future, they will stop paying a dividend. The other reason could be that currently the company had an exceptional dividend distribution because of good results, but that they will, go again to the normal level in the future. So that's less bad, I would say, but still something I would not invest in because I want to invest in a company that will pay me a dividend and grow it in the future, not cut it down. Also, usually companies with a very big yield have low growth rates of the dividend, meaning that yes, you will get some good returns today, but it won't grow a lot in the future, and then it might fall behind some stocks that would have a lower yield but also a better growth in terms of dividends. So definitely don't do this mistake and don't chase the yield. Another thing which is related to this one is don't ignore the fundamentals of a company. So don't just also focus on just the dividends and the growth and the yield, but also look at everything. Look, for example, at the payout ratio of the company. So that's basically how much percentage the company is giving to shareholders as dividends compared to what it earns or what was the profit of the company during that period. Okay? So for example, a payout ratio of 50% means that the company is giving half of the profit to the shareholders as dividends. So that would be like a healthy company, okay? However, you have companies that have payout ratios that are above 100%, meaning they have to use their own cash to pay the dividends. And that's also very bad. And that's something I was completely ignoring when I started, so really don't make this mistake. Because with a high payout ratio, it means that the company will basically, or at least might stop paying the dividend in the future, and that's very bad for you as an investor. So don't do this mistake number 2, which is ignoring the fundamentals of the company. And finally, the third mistake that you need to avoid, and that I also made at the start, is thinking that you can just invest or that it's best to invest in ETFs for dividends. Okay, so ETFs are some funds that are traded on like stocks, so you can directly buy on the stock market, and they are dividend-paying ETFs. Okay, and the problem is that the managers of those ETFs are basically just focusing on the dividend. So that's back to mistake number one. And therefore, on those ETFs, you will have sometimes good returns. So in terms of dividends, 4, 5, 6%, even more. However, it will usually never grow, okay? They will just like keep the best companies in the ETF that will pay a good dividend, but it will never like grow in the future. It will always stay at this yield, of 7, 8%, but the distribution will never actually grow. So that was also a mistake I made, because I invested in a lot of ETFs that were not growing the dividends. So if you want to invest in ETF, sure, do it, but also treat it like a normal dividend-paying stock and make sure that the distributions are actually growing in the future, or you will just fall behind. So these were my 3 mistakes that I made when investing in dividend growth stocks, and now you can avoid them. So don't chase just the returns. Look at the fundamentals of all stocks you are invested in, and also beware of ETFs and really treat them like a normal dividend growth stock. So I hope that this was useful for you, especially if you want to invest in dividend growth stocks. So if you have any comments or questions about those 3 mistakes to avoid, feel free to leave a comment below. Of course, don't forget to subscribe to my channel to receive more videos about investing, but also building your online business. That being said, thank you again for watching the video, and I will see you in the next one.